All right, we are recording right now officially. Woohoo! All right, Joe. So I don't know if you know, but I put up a poll out to the audience here. So I had about 3 questions I was asking. So people are responding to that as they see it on their side of the attendee screen.
Okay, I see the poll there. Yep.
So we got that going for us. Make sure I answer a couple questions. David Hagley, where the poll's at? Let's see. I don't know where it is on your button, but there's like a Zoom button that has like your video and your audio muting and stopping capabilities. There might be a polling thing in there, or there's a more ... button, and you can click on that to find polls as well.
Okay.
All right, so there we go. There's my big disclaimer. So we'll get right into the meeting. Keep on filling out the question and answer board if you have questions and stuff, and we'll respond about the poll here in a little bit. Use the chat board as needed. So the meetup, we have sponsors for our meetup. This wouldn't be possible without any sponsors. So obviously our company, Bright Path Notes, we got the note deals. That's my name, my phone number, my email. There's the one time I'll give out my phone number. So write it down now. So Cyria, our real estate education company. It's our local RIA group. We live here locally in Indianapolis, Indiana. And our Central Indiana Real Estate Investors Association, our executive director, who Joe knows very well, Miss Vicki Perry. There's her phone number and her email address. Thank you. She always loves those shout outs. They are also a sponsor for our meetup as well. We have joined with the Cyria group, so now we are a subgroup. So we blended our meetup group and the subgroup together, so now we have one large group. And then when we do have live meetings, Joe, we go at a place called Launch Fishers, and it is a shared workspace here in Fishers, Indiana, which I believe you're familiar with.
Yep.
And it's a great workspace. There's a lot of young entrepreneurs there. There's a lot of businesses, attorneys, different type of tech companies there. Been able to network with things. They have a great meeting room there as well that we utilize. And so that's where I do my virtual workspace there. Is at Launch Fishers. And so if those of you that live close to the area, check it out. Libby Hales is the person you would contact, libby@launchfishers.com. It's about $1,000 a year, Joe, to get space there. And so it's less than $100 a month, and you get to use a gigabit.
Great.
Yeah, you get to use a gigabit network. They have meeting facilities for you. They have private phone areas.
Wow.
And you can bring guests in. It's very centrally located to 116th and I-69, so people can get right off the interstate and go right there to meet. So that's, yeah, it's pretty nice. So we've enjoyed it very much.
Now, is that where you're coming from tonight?
No, I'm actually at my house.
You're at home. Okay, very good.
So the Launch Fishers is starting to open up. We're doing phase 1 of the 4 phases. And so they're starting to open up for just members only right now. So I believe late June and early July, they'll be full, not capacity, but full, whatever it is. They'll be full bore, is what I'm trying to say.
Full back on track.
That's right. Yeah, back on track, baby. So those of you that are in Cyria, this is important for you because this is your slide to get your PHP credits. Don't ask me what that means. I was just told to put this in there. So some sort of credit that you can get as a PHP.
Member of Cyria, yes, and I can't remember what it means either, but yes, I recognize that, Justin.
Yeah,
I've been around a lot of RIAs.
Right, you probably know them all 100 of them. So the URL link down at the bottom, http://bit.ly. Cyria Notes, just go ahead and plug that into your web browser, your phone, or whatever, and you'll start getting PHP credits. I promise we're almost done with the intro stuff. So, Joe, I have a podcast. I have a podcast.
And by the way, Denise just said professional housing provider. So I thought I'd read that for you. There you go. Prefer, not prefer. There you go.
I should know that, but I have to be honest and say I probably have heard it 15 times because Vicky's probably beat it in my head, and I just, it's just like my wife tells me. She's like, it's in one ear and out the other. I only got like 3 inches of space between my ears. So
there you go. Me too.
Anyway, Joe, we got a podcast. It's our 2nd season. We now named it To the Two Wealth Show. We're on all the podcast directories and also on the Bright Path Notes YouTube channel. We video record the podcast as well. And Mr. Joe Varnadore is going to be one of our guest interviews the next time we record, which I believe is next week, Joe.
Yeah.
You excited? You're going to be even more famous now. You're going to have 2 more followers.
So I got to ask you, who is Super E?
Super E is my co-host.
Okay.
It's not an alter ego. It's actually a real person. She's my co-host.
It's a person, isn't it?
What's that?
Is it a female person?
Yeah. So her name is Elizabeth Sickles.
Okay.
She's our Airbnb kind of specialist here in Indiana.
You told me that.
And so she knows her stuff. She's very, very up to speed on short-term rentals. And she knows a lot of big-time people in the short-term game and has brought some pretty cool guests on, which will be actually the next episode airing next week. We'll have a big guest on there as well. So anyways, that's the podcast stuff. Joe, let's get into today. Today's May 13th. Note Meetup. Who is Joe Varnadore? We'll answer that question here in a minute. We're going to go over the note basics. We're going to get into industry updates because I'm sure you all have heard it about COVID-19. We're definitely going to talk about it today. And but it's going to be a good conversation. What's that?
What is COVID-19? I haven't heard of that.
I don't know. I think it's called the Dos Equis virus. So we'll go over industry updates. And Joe, I got something fun at the end. It's called What Are Loans Worth?
All right. What's a duck worth?
Yeah, that's right. What is it worth? I don't know. You tell me. So, all right. Greetings from Okeechobee, Florida.
How did you find that? Seriously.
Oh, that's awesome. So Okeechobee Joe
is a restaurant that was called Cowboy Steakhouse. And that's pretty darn cool.
Here we go.
A little geography lesson here, Justin.
Okay.
Okeechobee is a Seminole Indian word, and it means big water, right? So we have a Seminole Indian population here, and so it is. And Lake Okeechobee is the second largest freshwater lake, fully contained in the U.S. So hence, Okeechobee means big water. That's right.
So greetings from Big Water, Florida.
That's right.
So I've dubbed you as Okeechobee Joe. So if anybody calls you that now when you're out in public, you'll know they got it from me. Oh, by the way, Joe, when you were out, Tom Manuel asked if you were buying the first round of drinks today.
I am. Yes, I will buy the first round of drinks.
So Reggie asked, what do we need to do to be a Cyria member? So you want to get a hold of Vicki Perry. And Reggie, if you want to reach out to me after the meeting, Justin at brightpathnotes.com, you can, I'll get you Vicki Perry's information so that you can be a Cyria member of our group. We'd love to have you.
Say something, Justin, about Cyria.
Go ahead.
And look, Justin and I first met there, and I can, Vicki she's an amazing lady, and she's just, she's been an inspiration to me. I know she's been an inspiration and a big proponent of Justin and Bright Path Notes, and she's just great, and that whole organization is amazing. I've probably been to 200 RIA groups all over the United States, maybe more than that, and I can tell you that's one of the top three, maybe the top.
Thank you. That's speaking volumes to the fact that, you've been to every RIA in the continental U.S., right?
Maybe not every one of them, but a lot of them, right?
Right. Well, sorry, Reggie. Since you are a member, there is a slide. Let me go back for your benefit, Reggie.
Hold on. Okay. Yeah, I want you to go back to that slide. I'm just going to get a picture of the greetings from Okeechobee.
I'll come back for it because I got some more fun stuff for you to look at.
Oh, you do? Okay.
So, Reggie, write this URL down. I'll give you a few seconds here, sorry. And that's what you want to plug into your browser, and you can log in and get your credit, okay? All right. Let's fast forward to Okeechobee Joe. So let's talk about Joe for a little bit. So there you are. All right. So here's a picture of Joe, me, Eddie Speed's on the far right, and Bob Repass is on the far left. So I'm a Note School member, and Joe is a Note School teacher. And Joe is definitely a mentor and more of a friend to me. We became real good friends a few years ago and been tight ever since. He's helped me out many times. So I appreciate it very much. And so this year at Note Expo, I got to enter in this case study, and I've talked about this in one of my meetups for you guys that haven't been to that meetup before. It was back in November, where I entered in a case study, and it was a performing note case study, and I actually won the competition because our peers vote on who has like the most creative or the most unique or the most coolest case study or whatever. So I ended up winning. So I got to get up on stage in front of a few hundred people and just kind of review my case study of what happened, the deal that I did, and how I made money, and how I was able to shift around and do some creative stuff. We don't have time to get into the exact details of the case study, but maybe I'll bring it up for another time. But so that was,
Justin,
anyways.
there was over 500 people there that day.
Yeah, but 3 of them were sleeping. 300 of them were sleeping, so they didn't get to see it.
No, man, they were right on top of it, man. They said Justin is the man.
Yeah. Right. So, anyways, that's one of the recent photos we have of each other. Here's one back in the day.
Yep,
At one of the Cyria meetings, I think. So we got the good old Colts helmet in the background there. I was a little bit younger, right?
Black shirts on, yeah.
Yeah, we were batching. We woke up looking that way, man.
That's right. There you go.
I look a lot younger then. You look the same.
Yeah, right. Oh, God.
And so this is a better picture. There's my wife, Vicky. There's Joe. That's Eddie's son, Hudson.
That's Hudson. Yep, that's Hudson.
Hudson is a character.
Was that at Eddie Merlot's?
Yeah, it was at Eddie Merlot's. Yeah.
That was a great meal, by the way. Yeah, that was great.
I had to treat you right when you come to Indy. I had to treat you right.
There you go.
Set me back a little bit, but I had to treat you guys right.
That's right.
There, good old Eddie Speed there is with us as well. And okay, Joe. So let's put things into perspective. So we got Okeechobee on screen right, and we got Lapel
right there. Yeah.
So Lapel, Indiana, is where I live.
Right.
I want to see. I want you to know how small my town is. Okay. So how big is Okeechobee?
So
population-wise.
So Okeechobee is the only city in Okeechobee County. There's 54,000 in the entire county, and there's 5,400 in the city of Okeechobee.
Okay. 5,400. All right.
Yeah.
Lapel's a little bit smaller.
Is it?
Okay. Let's zoom in a little bit. Okay. Let me put things in perspective for you. Okay. So this is according to Google. They've outlined Okeechobee on the right, and they've outlined Lapel on the left here. You can see Lapel fits inside probably 2 or 3 times inside Okeechobee there.
There you go. So, and if you look right there, you see the where it says Parrot Island. Well, you see Lightsy's Fish Company there. That other restaurant is right about 100 feet away from that. Greetings from Okeechobee, where you see right there on the bottom of the screen, Lightsy's Fish Company there. Yeah.
Can you see my mouse moving?
Yep, I see it.
Okay. Yeah.
About 100
so right
yards
around there.
Yep.
Awesome.
Yep.
Well, yeah, here's good old Lapel. So we have Ice Cream Plus is our famous place to have ice cream, and they serve burgers as well. And we have 2 gas stations.
You have a Dairy Queen, see?
Well, Ice Cream Plus is not like a Dairy Queen. It's a very small side, like, vendor shop, I guess. It's really? Very small. We have 2 pizza places, and they're literally right next to each other.
Got a funeral home there, yeah.
Yeah, well, we got to have one.
Yeah.
You know, and our population is between 2,000 and 3,000.
Well, it's interesting how, you got the funeral home, then you've got the cemetery right over there, right?
Yeah.
And Hoosiers Reel. What is Hoosiers Reel?
I don't know why that popped up. I really don't know what that is. I'm very new to Lapel. I've only been here about a year. So this is just where we live. So it's just about 10 or 15 minutes kind of north and east of Fishers.
Gotcha.
It's not too far. Anyway, we'll fast forward. I'm sure people are not having fun with that. So let's get into the note basics, Joe. I like to start off with what I call the note basics for folks that haven't really been on our meetup before and understand really what we're talking about. So we're talking about buying mortgages. And so when a mortgage happens, pretty much you got a buyer and a seller in a house, right? It's pretty simple. The seller has a deed. They convey it to the buyer and at the title company. And then the buyer, they need financial help, right? They need to get money to be able to pay for the house. They put down a down payment and they get what's called a mortgage, a note and mortgage. And so that bank owns the note and mortgage. And then that is secured. The mortgage is secured by that piece of property right there.
Right.
So just to be clear, the bank owns the note, not the property. And the buyer owns the house, and they actually hold the deed. They hold it in their hand. Their name is on it, right? Okay, so this is how we get into the note business, right? So we got the deeded owner, and we got the the bank that holds the mortgage note, and they have the security of that house. And then we got Mr. Investor over here. That investor could be an IRA, could be an LLC, it could be a Joe Varnadore, it could be Justin Bogard, it could be a trust, it could be a variety of things. Whatever has money and can put title to something is what this investor is on the side. And this is the most important step right here. The cash for the note. That's the only thing that's happening. The deed stays the same. The buyer is still the owner of the house. Nothing changes. But now the payments, instead of going to the bank, they go to the investor or that entity or that body. So just want to make that clear up front. We like to go over the note basics right from the get-go.
Well, and just kind of, just to kind of, to put that into perspective as well, is you can, there's a couple of different ways to be in the real estate business, right, Justin? You can either own the house, or as the first slide that you showed said, or you can be the bank.
Yep.
So you can be the landlord or you can be the bank.
I love it. Looks like I got some poll results in.
Yeah.
So the question one I asked was, what do you think will happen to real estate after the quarantine is lifted? And mortgage default rate similar to 2010. Real estate prices will go down significantly, or seller financing opportunities buying or selling on terms. So I think everybody agrees that more or less most of the people agree that seller financing is going to be key. And I agree with that as well.
Yeah. Oh, absolutely.
What will be a better cash flow and investment post COVID-19, rentals or seller financing? And again, the audience speaks, seller financing. I agree. That is exactly what I think will be huge.
That's right.
Will you put money back in the stock market? Yes, no, possibly. So most people are saying, over 50% of the people are saying, no, they won't put money back in the stock market. Right. And this is the same thing that happened in 2008. People said that, but also people put money back into it. So I thought that was interesting. So let's get on with it. What's happening right now? I think we've talked about this enough already. We're talking about COVID-19, the coronavirus that's happening right now. So an article that Joe and a friend of mine, Kevin Moore, wrote is called The Real Reason COVID-19 is going to impact the real estate market. And we're just going to hit some highlights on this because I know we're going to get into some other fun stuff here in a few minutes. Okay. So right now, everyone involved in the real estate industry is discussing the potential and positive and negative impacts that COVID-19 will have on the real estate industry. It is confusing, isn't it, Joe? You hear a ton of stuff, right?
Yeah, it is. It is very confusing. Yep. And if it's confusing to you and I to sit here and talk about it, just imagine going out into the marketplace, trying to get a bank to lend you money to buy a house.
Yep. Yeah, it's confusing.
So I've got a quick story for you. So my brother-in-law is a doctor, and my sister, they've been building this, $1.5 million, $700,000 house for the last year and a half, and so they had a construction loan. And so it went from they got their CO, certificate of occupancy, a couple of days ago. And so they had to go from their construction loan to their permanent financing, right? And 2 months ago, their rate was 3.5%. When they closed yesterday, it was 5.5% on a $300,000 loan. That's a $7,000 a month monthly payment. It's about $1,600 more than it would have been 2 months ago.
I mean, that's
now we're talking about doctor making $500,000 a year, 800 credit scores, debt to income ratio very low, but it's just they're lucky really that they were able to close.
Absolutely.
Everybody I talk to, you get you're buying a house, you get a temporary layoff, boom, you're not going to close. There's all of those things that are out there that are happening. It's just, it's interesting.
It is interesting. It is interesting. So, and you just segued right into what's going on today. So in this article, I'll kind of hit the highlights before we get to this part. But basically, the Great Depression of 1929, they got smart. The banking system got smart, and they came up with Fannie Mae, Ginnie Mae, and Freddie Mac, and they're called GSEs, government-sponsored entities. And their job is to basically help the banks get liquidity.
Right.
So they're gobbling up the loans that the big banks write. Like we're talking about Bank of America, Wells Fargo. We're talking about Chase. We're talking about Fifth Third. We're talking about the really large banks. And so that's their job, is gobbles loans. So when you hear things in the industry like Fannie and Freddie are selling off paper and stuff like that, that they have bought all the bank paper, right? That's their job. They're secondhand gobblers, I'll call them. And so I'll let Joe kind of take over, but basically they're the ones that are dictating what the banks are doing, because they're saying our buying criteria is this. And so the banks, their only option to get liquidity is to sell to Fannie and Freddie, right? So they pretty much do what they say, right, Joe?
So 2 months ago, you could have gotten Fannie or Freddie or Ginnie would have bought a loan from a lender that originated it with a 580 credit score with 3.5% down. Today, it's going to be a 700 credit score with 20% down.
That's a pretty big difference.
Pretty big difference. And the loan size is under $150,000. Look, you and I both know, we've talked about this a lot. Dodd-Frank kind of almost put sub $100,000 loans out of business. Nobody wanted to make a $100,000 loan, right? And so what's come up over the last couple of weeks is something that the lenders are now calling a COVID overlay, right? So if you're a local bank and you're originating a $100,000 loan that you're going to then, Freddie or Fannie is going to end up buying, right, from that lender, then if it's in a rural area, there may be a 1 point reduction, which would be $1,000. If the credit score is below 700, maybe 690, there'd be a 1 point reduction. There's other factors there, but bottom line is they originate a $100,000 loan, and when they sell it, they may only get $97,000 back for it.
Right.
So the banks have to make up that $3,000 loss that they would do for making that loan in fees on the other side, and that's if you can close. It's if they'll close it for you. So it's the banks are not going to get this time, are not going to get in this liquidity problems that they got into back in 07 and 08, right? And the crazy thing is we saw 07, 08 coming, right?
Yep.
Right, Justin? I mean, you knew that prices couldn't go up forever.
Right.
But I mean, we didn't know this until the day it started, right? Yeah. I mean, that's the nutty thing about this whole thing. Yeah. So it's what we're going to live with, and that's where the whole seller financing is. And let me just say this as well. So there's two types of lending, right? There's a qualified mortgage, which means that you check off all the boxes, and most importantly, and that is part of a loan being SAFE Act compliant. Dodd-Frank, it meets all the Dodd-Frank standards, so it's SAFE Act compliant. But the biggest key to that is that the combined debt to income ratio can't exceed 43% of income. So that includes all of your monthly installment and recurring debt, right? So it would be your new house payment, your car payment, your credit card payments can't exceed 43%. So if it falls under that, then it would be a qualifying loan, right? And that's where you're going to get your best rates. Now, that's what we should stick to really is if we're seller financing, we need to make sure that the loan is SAFE Act compliant. And Justin's probably taught you guys, to use a residential mortgage loan originator, an RMLO, to make sure it's SAFE Act compliant. But Justin, the crazy thing is that if it's more than 43%, it becomes a non-qualifying mortgage.
Non-QM?
non-QM mortgage. And 2 months ago, you could get a loan that had guaranteed by one of the GSEs up to 58% debt to income ratio.
How many? What percent was
58.
that? Doesn't seem right.
That's the whole smoke and mirrors thing again, right? Today,
Oh, geez.
you can't. And so what's happened is these lenders that were doing these non-qualified mortgage, which we call people that are not have to get a non-qualified mortgage. We call them a penalty box buyer. So Justin, it may be somebody like you or I,
Yeah.
real estate investors, right? And our main job being a real estate / note investor is to pay legally, to pay as little taxes as we possibly can. We have a lot of write-offs, and so we would be a non-QM borrower, right? Because our tax returns really doesn't reflect. I mean, it's all legal. I'm not saying anything. Or you've got, I-10 buyers, that are here legally. You've got people that are here that are, they're here on a contract basis, and they're trying to get trying to become a permanent citizen. And so, it's folks that are just self-employed 1099 borrowers. And those are the ones that really, they're great buyers. They're deserving buyers. It's just, it doesn't fit into that QM box. And so non-QM loans are really, really, really taking a big hit.
Yeah, we're gonna bring up a scenario here after a bit. So, so you guys read all this. We'll move forward here. So, this is some of the stuff Joe just sent me earlier today. So the tightening of credit standards, and we touched over this just a little bit. So this is a quote from Michael Neal, a senior research associate at the UIHFPC.
Yep, Urban Institute Housing Finance Policy Center.
Yeah, you want to talk to this?
Yeah, so what you're saying is that the availability of mortgage credit has dropped 25%. So at any given time, Justin, in the U.S., there's somewhere between 46 and 48 million single-family first mortgages in the United States.
How many?
46 to 48 million.
46 to 48 million.
I'm not talking about seller finance loans. I'm talking about bank, originated loans, right?
Okay.
So, back in the day, back in 07, 08, you and I know that 11 to 12 million of those loans were non-performing loans. And that was, when you first got in the business and all of that, I mean, that was the big thing, right?
Absolutely. Yep.
So what we're saying now is that the availability of somebody being able to buy a house is dropped by 25%. And so that, you say 25%, but that's 12 million people that can't get mortgage credit now to buy a house. And I don't know if you have that next slide that shows unemployment right now.
The picture didn't come through, so I couldn't put the actual.
Let me just tell you,
yeah.
Right now, today, unemployment is sitting at 34.5 million people.
34.5 million people.
So between the recession we had in 07, 08.
Yeah.
It was, we gained 22 million jobs. And so over the last 2 months, we've lost 34 million jobs. So we've lost everything we've gained, plus an additional 11 million jobs have been lost. So, banks are not wanting to loan money to, because they don't want to have that people lose their job and they have a first or second or third payment to default. And let me tell you something that just came out today, Justin, and that was that. So, if your loan was guaranteed by Fannie, Freddie, or Ginnie, right, you could get a forbearance. So basically, all of these lenders, and they were all getting these phone calls saying, yeah, we want and a forbearance just means you don't have to make a payment. The payment will be the payments that you miss will be put on the back end of the loan. That's a forbearance, right?
You're not forgiven.
That's a given.
No. I mean, you're not forgiven.
There's not forgiven. You got to pay it back,
Yeah.
right?
There's no forgiveness.
So some of these people are going, well, they got the forbearance. Now they're thinking, well, I'll go I'll go refinance because the rates are so low. They can't go refinance because they're in forbearance.
That's right.
Why would a bank refinance a loan
that
they're not paying on?
Right. They think they invented something new there. They circumvented something that was pretty
I have
glowing.
to laugh because it's just.
Yeah.
Can't
blame them for trying.
And so CFPB, which is Consumer Finance Protection Bureau, is getting flooded with calls and comments based on that particular item.
Right.
So
this is another slide that you sent me.
Mm-hmm.
Here's how COVID-19 infected. Is that 4 million, or was that an error?
I think that's an error because it's actually there's about I think it's about 12 million right now. This may have been an older slide, but yeah, there's about a third, not about a third, about 25% have taken advantage of this forbearance. Yeah. And again, that doesn't mean you don't have to, you don't have to make your payment today, but you got to make it later.
Right.
So you're just putting it on the back end, but
they're just putting a pause on it.
Yeah, you're putting a pause, which is great. I mean, nobody saw this coming. So, I mean, and you've got to applaud the government, whether you agree with all this bailout, all of this or not. But you know what? People are suffering.
So we got somebody raise their hand here. I'm going to allow them to talk here. So our, excuse me if I'm not butchering this, Mr. Hopple or R. Hopple, I'm going to allow you to talk here. I'm going to unmute you so you can unmute yourself here. If you know how to unmute yourself, there's a little mute button on your Zoom screen, and you can just click unmute on your side. Just because you had a question, you had your hand up, so I wanted to allow you to say something. If you can't, don't worry about it. Just throw it in the chat box or throw it in the Q&A, and we'll get it answered for you, okay?
Right.
So, all right. All right, moving on. So, sorry, we try to get you on there. So some borrower inquiries were misunderstood, and some servicers swamped with hundreds of thousands of calls. I can't imagine that. Just like credit card companies right now, they're just getting an influx of calls, right? So complaints to the consumer.
This is what I was just talking about. Yeah,
okay.
They just dumped everybody in, whether you wanted to be, a forbearance plan or not. They just said, forget it. We're just not going to take all these calls. We're just going to put everybody in a forbearance plan. Complaints to the CFPB have soared, with mortgage complaints leading the charge.
Yeah.
So money is cheaper than it's ever been.
Exactly.
Right. But you can't take advantage of it.
Right.
And, and they're getting ready to go back to as well. Some of the folks on the call may remember this, and I do. You're probably, you're a young buck, but we were back in the day. It was so you were buying a house. It was whatever it appraised for, or whatever it was, whatever the last sale price was. If the sale had been less than a year, whichever was less.
Oh, wow.
Yeah. So banks are just, they're saying, hey, we're not going to get caught in that. And so they've drawn the line in the sand. So interesting stuff, right?
So it does two things, right? They're trying to be responsible.
Right.
And they're trying not to have basically non-QM loans.
Right.
Okay.
Yeah.
But the con to it is that a lot of people can't get financial help to have affordable home ownership.
That's right.
And that's a problem. And
That's a big
Dodd-Frank put the kibosh on how many seller finance transactions we can do in a year without going through the proper channels of using an RMLO,
right.
having an underwriting, and going through the note and mortgage process.
Well,
So
and
this is why we're talking about this today. We've been talking about seller financing is a huge investment opportunity for investors. Unprecedented, right?
yeah, yeah, yeah.
Have you ever seen an opportunity like this for seller financing since you've been doing note
No,
business?
no, absolutely not. I mean, and I lived through, right when I first got into business. This really dates me, right? I got in when I was 19 years old, but when I did, it was like 1980. And that's when, you've heard of this, Justin, you've
Yeah.
read it in the history books, but that's when mortgage interest rates were 18%. You went to the bank, you got a loan, you paid 18%.
That's unbelievable.
And so that was one of the times where seller financing was just a lay down, because people would do a 12% seller finance loan, or they go to the bank and get an 18% loan, right? What were they going to do? Well, they were going to get a 12% loan. And this is just one of those times. I mean, if we would have tried to write a script for seller financing in the note space, we couldn't have written it any better than this. And I don't mean that in a way that
Right.
we would be taking anything for anyone, but and where seller financing fits in with all of this is, you've got somebody that they've got a house, and they may have bought it a year ago, they may have bought it 14 months ago. Prices were here. Prices are going to kind of level off a little bit, or it may not drop at all, but they may have gotten one of those 3.5% down loans. They have no equity in their property, zero equity.
Yeah.
And if you're a real estate wholesaler, you're not even going to go out and look at that house.
Right. It's over leveraged.
It's over leveraged. But if you know the note space, if you know how to craft creative financing, you can. Most of those loans, Justin, were 3.5%, 4%, maybe 4.5%.
Yeah.
But you can still make money out of that. Now you've got to do what we call a wraparound land contract. You buy the house subject to.
Mm-hmm.
And then you resell it on a wrap at a 6.5% rate or a 7% rate, and you make arbitrage. You make the money on the difference plus a difference in a down payment, and that's going to be one of the biggest ways that aside from all the other ways that we can do it, right, in the note space. But that's one of the ways that we can help folks that have no equity at all.
Yeah, it's the simplest way to explain it. Exactly what you did. You take a current paying mortgage and you pay on it, and then you resell the home, wrapping a note around it that's a larger payment and a larger interest rate and a larger principal balance. And you're, like you said, you're making the difference. The arbitrage is how we called it. So it's just the simplest way to do it. Right. And there are many different ways to do it, like you said, and that's just the simplest way. So number one question that I get asked, and I know how to answer it, but I really don't have a crystal ball. So I make sure that I preface by saying, I don't really know what's going to happen in the future, but people seem to think that there's going to be a mortgage meltdown like none other, because of, you hear all this information about unemployment, and you hear, about the job loss and stuff. And I pump the brakes a little bit from my stance, Joe. And I say, yes, the current mortgage default rate was 3.28% before March. It normally is, in a normal economic time, about 5 or 6, maybe 7% mortgage default rate for the country. This is all loans, not seller financing. This is just all institutional loans. And so at its worst in February in 2010, it was 11.5%, right, Joe? Mm-hmm. The mortgage default rate for the country. Mm-hmm. So people
were in some state of default. Some state. Some were, typically a mortgage is in default after 90 days, but I think that included the 30 days as well. So it could have been 30 days. It could have been 3.5 years.
Now, Grant, that's a lot of defaults, mm-hmm. but we didn't see that after 2000, 2008, 2009 until about 2011, 2012, 2013 is when you started seeing it. So if there is going to be a large default mortgage crisis, don't hold your powder dry that long. You are making a big mistake if you hold your powder that long. meaning
Well,
don't count on non-performing loans coming down the pipe next month. It's probably going to take, at minimum, I think it's going to take about 16 months for you to see anything,
right.
because Fannie and Freddie get them, then it goes to a $1 billion hedge fund, then it goes to a $500 million hedge fund, then it goes to a $100 million hedge fund, then it goes to 50. It takes a long time for people to slice off and see that. So I just want to throw that out there. That
Well, I was talking to, and you and I talked about this
yeah,
the other day. Talking to one of a friend of mine from Phoenix, and you know, they did 350. They wholesale flipped 350 houses in Phoenix last year, and
yeah,
he said, "Oh my God, short sales are back, baby." And I said, "No, they're not." Right? Just like non-performing loans are
yeah,
not going to be,
right.
Justin, when you first got in the non-performing, in the note business, we were buying a non-performing
Oh,
loan at about 30% of the
it,
value of what the property was worth.
you almost couldn't believe it. You're like,
Yeah.
seriously? I mean, that
Yeah.
is pennies on the dollar.
And I don't know that that's going to be the case coming up, but
Yeah,
right now, there is a process that lenders go through before they will sell those non-performing loans,
yeah,
and they go through a charge-off process. Now
right.
they're not going to take a loan that they made in January, they made in November, and the first payment was due in December, and now and it's $150,000 loan, and now they didn't make March's payment, April payment, May payment. Um, they're not going to sell it as a non-performing loan next month. They're going
Right.
to write that off, charge it off over
Hmm.
time, and then they'll sell the loan at a big discount. It'll be
Right.
somewhere between 30 to 50, 30 to 35 to 55 to 60% of the value of the property.
Yeah.
And don't worry about the big banks, right?
Yeah.
Don't lose any sleep about them losing money, right?
Yeah.
Because the taxpayers are going to make them whole, right, Justin?
Yeah. And insurance too, right?
Yeah, there you go.
Private mortgage
There you go.
insurance. So,
And so that's something that's down the road.
yep.
And again, that to happen though, that hurts a lot of people. But Justin, I've owned properties before that that if somebody would have came along and said take it, I would have said here, you can have
Yeah.
it, right?
Yeah. Right. Yeah.
So
Yeah.
that is a thing.
Yeah.
Yeah.
So thanks for answering that and beating that up a little bit, because that is on everybody's mind, because it is apparent there are going to be more foreclosures. No one would ever deny that. I
Right.
don't think it'll be the magnitude, because I think there's a lot of, for all the unemployment that's happening, there's also a lot of re-employment going on, because there's a lot of businesses that need employment. So there's going to be some sort of balance. And this is just my take on it, so take it for what it's worth. So I don't see it being as bad as 2010, but hey, I've been wrong before, and I'll be
Right.
happy to admit if I'm wrong. But anyways, if it is wrong and it's going to be a catastrophe, then guess what? It's going to take 16, 18 months for us to see it anyways. And
Absolutely.
all you're
Absolutely.
going to do is help people out. That's
Right.
what you have to think of it. You're helping somebody out. You're able to take over their mortgage. You can remodify it. You can help them make payments. It's a really awesome feeling. And Joe, I know you've done it 10,000 times in your day.
Yeah.
So
And I was talking to a friend of mine out in California. He lives in Modesto, and he's a big wholesaler, out there, but he does rehabs and all that. And he says, he gets a call from a lady that wanted him to come out and look. She had, she was an Army recruiter, lived in Modesto, single mom. You were a single dad for a long time, and two girls. And so she lived in Modesto, wanted to buy a house, finally found a house she could buy. $325,000 she paid for it. She's VA, so she got a VA entitlement with no money down and all of that, and it was a 4% loan. She lived in the house for 10 months and got transferred to Philadelphia. So she wants to sell this house. She has no equity. She wants to sell it fast. She doesn't want to rent it and be a landlord and all that. And so she calls a friend of mine, and he says, "Yeah, I can work on that." And basically, she just said he took the loan over subject to, meaning,
yeah,
I'm going to make your monthly. It's a 4% loan. I'm going to make your monthly payment. And basically, he took the loan over subject to. He advertised to a penalty box buyer, a non-qualified mortgage buyer, on Facebook Live.
Yeah.
Sold it within a week for
Wow.
$340, right? And I think he did it at a 6%, six or 6.5%, which is a non-QM rate, right?
Yep.
That's still a fair rate.
Yep.
Well, look at my brother-in-law; they just got a 5.5% rate on a,
Yeah.
Anyway.
Wow.
But so he made $15,000 up front on a deal, and he's making about $800 a month between what the underlying payment is and the payment that he's receiving to this non-QM buyer. And and Justin, you teach everybody this as well, but he uses a loan servicer that receives the monthly payment, pays the underlying, and sends him the difference and takes care of the taxes and insurance. So that's a pretty passive investment, right? I mean,
Absolutely.
and the other thing too is guys, even before all of this happened, well, Nathan Long, president of Quest IRA,
Yep.
and talking to Nathan here 10 days ago, 2 weeks ago, and right now, they've got sitting in uninvested cash in a self-directed IRA. They have about 25%, over $400 million sitting in self-directed IRAs that's invested in nothing. They're still paying fees for it being there. And that's just going to go up because people are like, well, shoot, I'm going to take my money here and I'm going to put it back over here because I don't want to, it's preservation of capital, right?
Yeah.
And and you've done this and you've done a good job at it, but there are people out there that just want to, man, if they could find an investment that a safe investment that they could get 5-6% on, they're all over it.
Yeah.
And I was talking to Jeremy just a little while ago. He's got an investor there, and he lives in Dallas, Fort Worth, and he had an investor that came to his little meetup and said, Jeremy, I want to invest in notes, and I think, and it was a 5% loan, right? 5% interest only loan that Jeremy was able to get from one of his investors, and it made total sense. And so people aren't thinking of 10 or 12 or whatever it is rates of return. They're wanting a safe haven to put their money into in a safe investment.
Yeah. Pretty slick.
Yep.
So Michael Thompson, shout out to the board here about how can we get that list of people with the money sitting on the sidelines? Well, don't you, there's about 10,000 people in front of you trying to get that list as well, my friend.
Well, you know what? There is a way.
Yeah.
And I did it the other day. Basically, you can go to the it's called FBO, right? For benefit of. You go to the property records, and when you see someone that has made a loan out of their self-directed IRA, it'll show, Justin Bogard, Quest IRA, FBO for benefit of Justin Bogard IRA.
Yeah.
And it'll show that person as a lender, and there you go. So, there are people out there, and you've got folks that are landlords right now that are wanting to not be landlords anymore.
Yep. Yeah. Joe, I think that was an awesome discussion. Thanks for giving me those last minute slides, those details about it. This was a great topic just to go over COVID-19. And I know everyone beats this up a lot, but I think it's really good to hear it from the note side of this and to know, especially what you've been through and been able to talk about your experience and what you've seen and what this is obviously doing right now. I mean, I've seen seller financing start to rise since last summer.
Yeah.
And I've started to see signs in the yard to say for sale by owner, a lot. I noticed places were closing down. The smaller businesses, especially being here in Lapel, it's obviously easy to tell, but there was quite a few signs in the yard. And so that's what told me that seller financing is starting to to come on
Right.
even stronger. So we have opportunity to help people out, folks. Let's get out there and make it happen.
And guys, some of you are investors, and right there's a guy that can show you how to, right there, that not this guy, but that guy right there in your local market. He can help you invest some of that money you've taken out of the stock market right now, right, and get a good safe return on that.
Yeah, we definitely have ways to deploy our, and we're investing heavily right now as well. Joe, let's take this over to a different topic, and I call this game I just made up. It's called Price That Note. It's not really a game, I guess. It's just for fun here. I like to. I notice a lot of people in the note business that don't really know how to price loans, and they don't really know what they're looking for. And you're my teacher, and I go after notes probably the similar way that you do, but maybe with a different degree of complexity. Just because we're all just a little bit different how we do things. Like some people like to look at pay history, some people like to look at the collateral first. Either or is not wrong. It's just that's the way you do it. You wake up on one side of the bed because that's what's comfortable for you.
Right.
So price this note. So I got 2 deals for us today.
Well, hold on. Do I need to get my phone out and get my HP 10B financial calculator out here?
I already knew you had it tucked in your pocket next to your belt, your Batman utility buckle you got there. So is that your iPhone?
Yeah.
All right. So we're going to play Price This Note, and I'm going to give you some substance here on some of these deals. So you have not seen these slides, right? To the best of your knowledge, you have not seen any. To the
best of my knowledge, I haven't.
Okay. So let's get into it. So the first thing I want to make clear to everyone is we've got to understand there are 6 values to a note. Okay. And this is how we value a note, meaning this is how we price a note. These are the 6 things we should be looking for. If you are not doing this and you're a note investor, then you should fire your mentor. Okay. I'm just telling you, should fire your mentor. Okay. So step number 1, well, it doesn't matter in what order, but you have your collateral. You got your pay history. That means the seasoning of the loan, how long it's been paying. You have the down payment. Okay. And this is the borrower's down payment, right? You have the terms of loan, the interest rate, how long is it paying, the loan amount, yada, yada, yada. The paperwork, the documentation, is it on a napkin? Is it on a note and mortgage? Is it written in a land contract for deed, a bond title? What is it written on? The borrower. So these are the 6 things that value a note. All 6 of these attributes make up this magic number that we as a note investors say that's what it's worth. Okay. So there's no pre-can like, oh, it's 82.5% of value and minus repairs. And there's none of that. There's none of that.
No AOV all that.
Divided by the gross national product. There's none of that. Okay. So we're going to talk about 2 performing loans because I love performing loans. And quite frankly, it's just going to be easier for a topic of discussion. Okay. Are you ready?
I'm ready.
Your battery is charged. You're good.
I'm good.
Deal 1. Here we go. Let me move my video cameras away so I can see what's going on here.
Yeah, I know. That's kind of a pain in the rear end, isn't it?
Good old Indianapolis, Indiana. Here's a loan you can buy today. I promise you, somebody can buy this loan today if they want. Okay. Indianapolis, Indiana, $36,000 fair market value. It's a 1,100 square foot house, 2 bed, 1 bath. Okay. This is a fixer upper. The borrower is planning on doing a fixer upper with this. Okay. You got a good look at the picture.
Yep.
Okay.
But the as is value is 36,000.
Yeah, I think it's higher than that.
Not the after repair value, but the current value is 36.
Yeah, the street value with cash on hand is $36,000. Okay? Okay, this is important, Joe. Pay attention. I need you to focus. Okay. Note and mortgage. That's what's written on. Okay. All right, we got a purchase price of $32,000.
Okay.
We got a down payment of $10,000.
Wow.
You like this so far?
I love it.
Okay. You're not gonna be ashamed that I put this on the board. So let's do math. 32 minus 10 is $22,000. So that's the loan amount. Okay. We've got a 12% interest rate. Are you still liking this deal? 609.51 is the monthly payment, the principal and interest payment.
The deal, yeah.
It's 45 months.
Okay, so we've got a 12% loan. It's 45 months.
Yep.
Okay. And so the monthly payment's 609.51. All right.
Yep. This is the origination here, okay?
Okay.
So that's not what today is. This is the origination. Right. Pay history. ACH every payment from day one.
Wow. Okay.
I'm telling you, I find some good ones. I already know what price you have in your head already. Okay. The current unpaid balance is 17,000 and change. You see the number, okay?
See the number. So how many payments have they made? How many months of seasoning does it have?
Right. So we're going to get into that. So this will probably rent for $700-800 a month, this house. You saw the collateral. Right. You saw the documentation, what's written on. So this is what's, and I know you know this, Joe, but this is what's important for the audience's sake, okay? It's written on a note and mortgage, so it's in, I highlighted it in green, meaning that's good, okay?
Yeah, we got every loan's got its positives and every loan has its negatives, right?
Thank you, yes. So we have a note and mortgage, which you couldn't ask for anything better. We have the down payment, which that is a sizable down payment for the loan amount.
Yep.
The terms are pretty good for what this is.
Right.
Now, there are very short-term loans, this is a very short-term loan. It's less than 4 years.
Mm-hmm.
Typically, you would see loans probably go 7, 12, 15 years for this size.
Yeah.
So this is a very short-term loan. So what this does is a very quick amortization. So somebody's paying a lot of principal and very little interest every month because you haven't been able to take advantage of a long amortization schedule. So it can be good as you're the investor because then you get your return back quicker, right, Joe?
Right. That's exactly right.
Okay.
And you know, too, I mean, it depends on, I may have some money I want to invest for, you know, I want to have out there for 10 years. But if you've got, you know, some money you want to sit out there and you're going to get back in 35 months, whatever it is, then it's a great loan, right? So just depends on what you're looking for.
I already got some of my note nerd buddies already breaking down what the seasoning is, all that stuff. So that's good. That's good. I'm glad we got some
calculators
on here. Okay. So what else is good about this? Well, we like the ACH, the pay history. So we've got 4 factors on here in the green for this note. And I don't even think we need to worry about the borrower at this point, do we, Joe?
No.
I say the collateral is okay. I wouldn't say it's a palace, but I'd say it's fine to me.
You know what? And the borrow, you know, this, you and I know that somebody bought this. They got great terms on it because they bought it. Now they're going to fix it up and they're going to resell it. And the likelihood that this goes to term is highly, even with a short term, it's highly unlikely, right?
Yep. So everything looks pretty good from this. And so here's where you're going to get into the pricing, Joe. Okay. So here's our current UPB. Here's how many payments are left on it. So 33 payments. Okay. All right. So there's 2 different categories that we're going to price this loan at. Okay. Category 1 is going to be what we call retail buyers. So that's any of us on this call. Okay. We're all going to be retail buyers. We don't have $500 million behind us to go out and buy a couple thousand loans and get wholesale rates, right?
Right.
All right, Joe, a retail buyer, what would retail pricing go in your opinion on this loan? I already have my number figured out. So if I'm way off, then I haven't been taught very well, but.
Okay. So let's see. I'm at about, I don't know. I'm about 14 and a half, 15,000. Yeah.
All right. So I had a little different. So I had about 16,500 to par based on the attributes that I saw.
Right.
So let me talk about that a little bit. So I saw this as there is an extreme amount of protection for someone that would buy it.
Huge.
You're basically at a 46% ITV. So ITV is called investment to value ratio for those of you on the call. So if you invested, let's just say $16,500 in this deal and it's worth $36,000, if something were to happen, you basically have half the money in of what it's worth, basically.
And, Justin, talk about LTV. So LTV is what the buyer.
Yeah.
Okay, you got it. You're sorry.
Yeah.
You're professional. I'm not going to jump on that, right? You go ahead.
You beat me up long enough. I'm just kidding.
There you go.
So
go ahead.
This is a pretty strong return for the investment, but you have to realize that the investment is a very small investment, and it's set up to where it's one of these unicorns to where you have the best paper you want it on, you have a sizable down payment, you have a pay history that has no imperfections in it because it's an auto draft. It's one of those unicorns. And so I just want to show that it's just a rare opportunity, but that's what some of these deals are. So 53% LTV, loan to value ratio. So the borrower's 50% of what they borrowed. Okay.
So Justin, what you're saying then is that if the borrower stopped paying,
yeah,
and so we went in and we had to foreclose on this, and we had paid $16,000 for it, 16 and a half.
Mm-hmm.
Then we have plenty of room to work ourselves out of this deal.
Yeah. I mean, in all actuality, I think the property is worth more, just because if you go off the income approach, it may be worth 50 or 60,000.
Oh, yeah,
with a $700 or $800 rent monthly, it could be worth a lot more. So
right.
There's just a lot of protection here, and we come up with different numbers. We're a few $1,000s off, not that big a deal. It changes the numbers a little bit, but all in all, it's a pretty low risk investment, and that you can pay closer to par for.
You're exactly right. And the way that I figured it, the reason that I figured it the way that I figured it
mm-hmm.
is you're in one of those parts of the country that you can see a lot of notes. I don't see a whole lot of notes that on a $35,000 house is what I'm trying to say.
Yeah.
Even in my market, that house would be $80,000 or $100,000, right?
Yeah.
I mean, in a little town where I live.
Yeah.
And 50 miles from me, there's $80 million houses on the beach, so over in Palm Beach. So you know what I mean? So it just depends on, it's the smaller note. And I was just looking for a little more of a discount, but that's a perfect note.
Yeah. Usually
note,
parcels are usually this size,
note,
right?
Very good.
Yeah. So it's very small note, very, very sweet return.
You know what else you could do, Justin? If you did get that back, I promise you could sell that to an end user
mm-hmm.
For $55,000.
Yeah.
Sell or finance it with $5,000 down.
Yep.
And you got you got cash flow for 30 years, right?
This is an ATM deal.
Oh, it is. Yeah. Yeah, we wouldn't even call that mailbox money. We just call that ACH money.
ACH money. That's right. That's right.
There's
our unicorn. All right. So now a hedge fund. Now, description of a hedge fund is it's just a big buying entity that has just 7 to 8 to 9 figures of money behind it that can just deploy. They don't really buy one-offs. They buy multiples at a time. Very rarely do they buy one-offs, but the smaller ones maybe, but the bigger ones don't. So I have something in mind. It's kind of a trick, but if you had to put a hedge fund, would they be interested in this deal or not? So I don't know if you would price it or not if you were a hedge fund.
Oh, okay. So yeah, a hedge fund's going to want to buy that loan at about half.
Right.
Yeah, of probably, they're going to be in the $12,500 range is what I would say.
Yeah, that's what I was thinking too. In this type of situation, they need more protection because they take loans and they have to make money on the loans because they're not holding them long term. So if they don't have a lot of spread in between, they have to take even bigger discounts. So I agree, they'd probably be in the $10,000, $11,000 range to buy it. So I think they would pass.
And then there's a cost to buy it for them too. because, that may cost them $1,000 or
Oh
more
yeah.
just to board that loan,
Yeah.
right? To put it on their book. So they're going to, they would pass on that. And Justin, I'll tell you a little quick story. I mean, we've got, my family, my dad and I, we've got about 85 performing notes in a trust. And, I've had people trying to buy, will you sell me some loans? And no, because I don't want to go have to invest it somewhere else, right? And the average balance is, I don't know, around 85. Average interest rate is around 8%. Anyway, I had somebody contact me last week, and they would have bought, if I would have wanted to sell, they would have bought every loan, 85 loans at par, at
Really?
100 cents on the dollar.
Wow.
But what am I going to, they're great loans. They've got 5 or 6 years of season. They're 30-year loans with 5 or 6 years of seasoning, right?
Yeah.
I mean, how do you, what do you do with the money when you get the money?
Exactly. Yeah.
Right?
You'd be Scrooge McDuck. You'd be like swimming in the coins in your
I got to go.
tower.
I need to go out. But you think about that, and of course, there's other ways that we could sell some partials, but I don't need the money right now.
Right.
I don't mean that in a bad way. I just it's Rudy's pretty sharp, right? He's the COVID overlay.
Yeah, Rudy, he's seasoned now. And funny story, speaking of Rudy, because you brought him up, I sold him a couple of loans, and they were like my most favorite loans I ever had. And I sold it to him because I wanted him to have some good loans. And man, I still regret that decision. Maybe I ought to buy it back from him.
Well, that's just it. I mean, I go out and I sell, and we originated not every one of those, but we had a bunch of rentals, right? So we sold them. We got out of the landlord business and we sold these houses. It took me two years to sell all these houses, and we noted them out, right?
Yeah.
And so we created loans. We became the bank versus the landlord. And I know every one of these loans intimately. So, if I sell them, I'll regret it, right? So,
exactly. Yeah, you got a long history with them. I mean, do you all have them? Do you have them with the same servicer, or do you use different servicers?
I do. No, every one of them are with the same servicer.
Nice.
And it's more of a regional, a smaller servicer. I mean, but because these loans are all here, basically where I live in this area, 30-mile radius. Yeah, so I've just left them there.
Oh.
The national stuff, I'm still a proponent of FCI. I use FCI for everything. So everything else.
So you're the town lender. So it's Mr. Joe's neighborhood, Mr. Varnadore's neighborhood.
Yeah, I'm kind of the Mr. Cooper of.
Cooper.
Yeah, for those of for those of you that don't know what we're talking about, so Nation Star was the largest servicer in the U.S. and so about 2 years ago, Justin, they changed their name from Nation Star to Mr. Cooper, and we're like, how do you pick a name like Mr. Cooper, right? Why don't they just pick Mr. Rogers if maybe they wanted something to sound a little nicer, a little,
Why did they do that? That would make more sense.
But but let me just tell you one quick thing here that it just popped into my mind. So all of these servicers, right, that are servicing these loans that have this forbearance situation, right?
Yeah.
So the servicers that are servicing these loans are continuing to make the payments to the underlying investors, even though these loans are in forbearance. Right? Yeah. Look that up and see what, servicing business is going to change a little bit here pretty quick too. Because what the servicing companies are doing is they guarantee the payments to the underlying investor, and that makes it a higher yielding mortgage-backed security, right? Okay. So they're paying these payments on these loans, even though they're not getting the payments. Anyway, I digress. So you got another loan here, huh?
I do. So I said pass from the hedge fund standpoint because I think they would put out a price. I'm not saying they wouldn't price it, but I'm saying that what they would want for it doesn't make sense for someone to sell it. So that's why I say it's just be a pass.
Exactly. And again, they're buying it because they're buying it to It's a small loan. They've got boarding fees, and they've got to make
Yeah.
a profit.
And yeah, they got to flip the loan as well. So they need to
Right.
make a sizable spread, and so there we go. We beat that up long enough. Okay. Deal number 2. This is the last deal. Okay. And then we had a couple of questions earlier that I hadn't gotten to yet. I was going to wait till the end to answer them. So deal number 2. So this picture was a little fuzzy. Sorry. It's from an old BPO.
I know this deal.
You do?
Mm-hmm.
You do know this deal?
I do.
Okay. Because I just went searching for some deals, and I found this one. I thought it was interesting. Okay. Performing loan.
I'll tell you a story about this after we get through.
Okay.
Okay.
So Wyoming, Michigan. I guess there's a Wyoming, Michigan. So that's what it is. So fair market value from a BPO, I got from BPO, is 128.9. Okay. So about 1,400 square feet. It's a 4.2. I don't know how they fit 4 bedrooms in there, but they did.
They're
9 by 9s.
pennies.
Yeah. All right. So it's a land contract. Everyone understand what a land contract is? If you don't, I'll quickly explain it. So a land contract is basically a contract between the seller and the buyer, and the seller is carrying the financing for the buyer. Mm-hmm. So the seller doesn't give the deed to the buyer yet, because the buyer has to make all of the payments in full for 30 years or whatever the contract's for, and then they get the deed at the end.
It's like a car loan, right? When you buy a car, you get the title when you pay it off.
Exactly. So that's the difference between the land contract versus the note and mortgage.
Right.
All right. This is actually a loan modification.
Mm-hmm.
And since you know this deal, if I missed some of the details on it, please let me know. So It was a land contract, and then it got modified. So how we look at this in the note business is we just start fresh from this point.
Right.
So just for clarity's sake. So I guess there is no down payment, right?
Right.
Right. So the loan is $110,000. All right. So I don't know what it was before, to be honest with you. Like I said, it kind of doesn't matter. We just kind of start fresh at this point. Okay.
That's right.
So it's a 6% interest rate now, $660 payment. So it's similar to the other loan that was only $17,000, but this is $110,000. So isn't that funny how the amortization works?
Right.
And it's 30 years is how they amortized it. All right. So now we're going to go into the pay history. And what I saw about 12 to 15 months of pay history on this.
Right.
It was mostly on time. Mm-hmm. So Joe, it was a check. It was a money order. Some of the payments were early. Some of them were right at the due date, and very few of them were after the grace period. So to me, it seemed like they were mostly on time.
You know what I've always said, Justin, when you're looking at seller finance properties, people say, well, what do you consider an on-time payment? I said, as long as I get it before the next one's due.
I didn't see one that broke that rule.
Right.
So looking back the last 12 months, if you didn't see that, are you happy with it?
I'm happy with it. Yeah.
Okay. All right. So the current unpaid balance, I don't know if this is this month or last month, but it's $104,000 and change. Okay. So the factors that I want to point out on this loan about the 6 values of a note. So it's a land contract. So I put it in yellow. So it's not green. It's just a step back from a note and mortgage. So it's not as valuable. Would you agree?
I would.
Okay. Now in red, there's no down payment because we know it's a loan mod. And I think the mod was done in 2016.
Right. But the thing of it is, I think these people have owned this house though since 2012, haven't they?
Yeah, it could have been. I didn't see the original land contract. I just had the loan modification in front of me. So like I said, that having no down payment, we know it's a loan mod. That is obviously against them at this point. Okay. And then the terms of the deal, they're okay. They could be a little bit sweeter. It could be a higher interest rate. It could be a shorter term. There could be different factors to it that can make it a little bit better. So we put those in yellow. And then we both agree that even though the pay history sounds a lot different than an ACH, we still agree that it's a pretty good.
Right.
Okay. So I like this so far. So like we said before, we have factors that are in the yellow. We have factors that are in the green. We have factors that are in the red. It still doesn't matter if one of them is in the red, you're not pulling the trigger. It's just, it changes the value. So the collateral was good. So that's in the green, and the down payment was in the red. So we'll kind of take those standard deviations out, and then we just got what's in the middle. So hopefully people get that horrible analogy. So we got $104,000 left. 317 payments are left is what I calculated, Joe.
Right.
All right. So we're just doing quick numbers here. There's no method to our madness. We're just kind of throwing a dart at a dartboard and seeing this is how we both land on this for a retail buyer. So this is someone that's going to be any one of us on the call. Like I said, a retail buyer, not a hedge fund or a big institution like that.
So where would I want to be if I were buying this myself?
Well, retail buyer. Call retail buyer. Anybody first time in the business, whatever. Someone looking for a loan. We just that generally is a retail buyer. Like if you're buying several loans at a time, you're probably not going to be a retail buyer. Buying one or two at a time.
So you tell me your number, Justin, and then you show me yours, and then I'll show you mine.
Because you show me yours first. Okay. So I landed in about the 88 to 95,000 range. I put a range in there because this is a larger note, and there may be some factors that I would want to lean towards the 95 or lean towards the 88. I don't know yet because I don't have enough information. I just have what's in front of me. And so someone says, Justin, price this note. What do you think it's worth? I'd be like, blah, and that's where I would land. So I'd say a retail buyer would pay that much for that loan unless I found something that would prohibit us from paying that price, or maybe it would be lower.
Yeah, I'm thinking I would be in that. I'd be in it at 88 to 90.
Okay.
Okay. I wouldn't go as high as 95, but I'd be in it at 88 to 90, somewhere right in there.
Okay. Well,
that was my number.
If you take the 88, the low side, we're at about just under 70% ITV. So that's still pretty good. I mean, when
really
the fair market value is almost 130,000 on that house, so that's still pretty strong. You're pretty well protected there. The yield is pretty modest. It's not as strong as the first one, but it's pretty modest because you have a very large note relative to the first one, right? It's about 4 times bigger. And the LTV is a little bit different. It's about 95% for the borrower. But in this case, we know that we have a lot of protection with the ITV.
That's correct.
So with the hedge fund, then again, just like the topic we talked about last time with the hedge fund on the first deal, they are buying thousands at a time. They have big buying power. So they are obviously going to get a different rate than a retail buyer, a person buying 1 or 2 loans at a time, right?
Right.
So I wasn't really sure where they would be on this loan. So I kind of threw a dart out there and I guessed where they would need to be able to, like you said, all the fees they have to pay, be able to take the loan in and be able to flip it to somebody else. So I'll just show you mine. And so I thought they would be around 55 to 70,000. I know that's a bigger range, but I wasn't sure where they would land on the spectrum of things. So if they bought this in a 100 or 200 loan pool, I think they would be paying a lot less.
Yeah. And I would be somewhere, my number is somewhere between 59 and 63.
Okay. So you got a little tighter because you know what the funds are paying better than I do, but at least we're close. Okay. Closer. So that's good. So that's the game, Joe. I think we did pretty well. And I hope everyone that was following.
Here's what I want you to do. I want you to go back and I want you to go and look at one of the, a recent free, one of the free sites like Zillow and plug in that address on that and look at what that house looks like today.
Okay.
It's got $180,000 value.
And see, that's what's cool. So if we were to take these loans again and we were to actually dive in and spend 10 minutes on them with our own research, I think we would come up with different values and maybe either tighten it or maybe allow ourselves to be like, oh, I can pay a little bit more for that because of these reasons,
Right. But, again, I think that, if you had someone, Justin, that had some money in a self-directed IRA, or just had some money in the they had some money they wanted to invest.
Yeah.
I would well, let me just do something here. Yeah, I would be, you know, yeah, 95,000 is a good number on that for somebody that, I mean, could you imagine, that somebody putting in, buying this note for 95,000 bucks, house is worth 128. That's a 7% rate of return. You got 317 payments remaining. Do the math
Yeah.
on
And guess what's going to happen though? That you and I both know the story. It ain't going to get to 317, is it?
that.
No.
About, anywhere from 4 to 7 years, it's going to pay off early. They're going to refinance it. They're going to sell it and move somewhere else, whatever it is. But we know that I'm not going to go 100%, but I'd go 98%.
Yeah.
That's what's going to happen.
So let's talk about. Oops, sorry, I went back a slide. Let's talk about that real quick because we have time, and then we'll open up for some Q&A and answer some of those questions at the beginning of the call today.
Got it.
So I've wrote a blog about this, and I'm surprised that no one else writes blogs about this exact factor because you have short notes and long notes. And so we've obviously shown a short note at the beginning, a small entry point, a very high return, a very extremely, I hate to use the word safe, but it's extremely low risk deal. And then we got a different deal at a higher value with different marks, but we still valued it very strong because of the attributes of the loan.
Well,
So,
and let me just say one thing. Understand, if you had somebody, if somebody bought this for $95,000, remember they're buying $105,000 for $95,000, and the house is worth 130.
well, more. I mean, you found out that it was worth
Yeah,
really
it's actually worth
180.
about $178,000.
Yeah, so it's
You wouldn't
just
think it was the same house. I'm just telling you.
right. So it's, you're getting in at even lower ITV, which is hard to believe. So not that you want the borrower to have bad luck to them, but you're kind of thinking like, okay, if they default, I'm gonna be okay.
I'm good. Yeah.
I'm gonna be okay. I would prefer them to pay, but I'm gonna be okay.
Yeah.
But what I was getting at with the long notes versus short notes is there is so much interest that's accruing on this second deal versus the first deal. I mean, if you looked at the amortization schedule and you saw on that $605 payment that $500 of that's principal and $105 of it's interest, you would look at that deal differently when you saw this deal and you saw $500, $550 of this is interest and $100 of it is principal in the first, probably 15 years of this loan. It's going to be so interest heavy. And so when this
Right.
thing does pay off early, you've collected all that interest. And then so your yield is probably going to go over 10% on
Right.
this loan if it pays off, like you said, in 4 to 7 years or 4 or
Well,
5
the
years.
early payoff is, yeah, because again, in 5, we looked at that, and let me just hold on here. So if we looked at something like that, let's go back here, 6 PV, and if we looked at the AM schedule, and yeah, if it paid off in, I don't know, 5 years and 60 months from now, the loan balance is still $96,000, but you have received 60 payments of $660 a month.
Yeah. I mean, it's just,
And you're still owed $95,000.
and then in 33 months, you were making $605 in 33 months.
Right.
So if you work the math backwards, you'll find that this second deal may look totally different on the surface, but it has a ton of great things about it that are outside the 6 values of notes.
Right.
And so this is the other things that we look at as seasoned note investors about the opportunity of an early payoff. We can't predict it's going to happen, obviously, but it's there and you have a lot of different protections. So when I invest in notes for our own portfolio, this is just me, I like to buy longer notes for that reason. Those shorter notes, they look really good on paper and you see those monster yields and you're like, oh my God, my eyes light up. Like, why couldn't I buy this? Why should I buy this right now? Well, yeah, you'll make a good return, but your money's deployed very slow, very, very short amount of time.
Very short amount of time. And you're not getting the discount.
Exactly.
you
You're
bought
not
that
getting the
first
discount.
note. If you bought it at $16,000 and it was a $17,000 balance, you're buying it at $1,000 discount. You're buying this at a minimum of at 95. You're buying it at a $10,000 discount. So
A
you
minimum, yeah.
earn that unearned discount,
Yeah.
right? If it pays off early.
Yeah.
Yeah.
So hopefully that made sense to everybody on the call. This is something that a real note investor learns about this after they've had some seasoning. They see the real value in longer notes. There's nothing wrong with buying the first one. It's
Einstein
just
said that amortized loans are the eighth wonder of the world. For those who understand them, they own them. For people that don't, they pay on them.
Yeah.
So,
so I think this exercise I got some good feedback on the comment board, by the way. This exercise, I'm glad that added value to somebody, because these are the things that I wish somebody would put in front of me when I was first starting out as well. So I liked how Joe's been doing this business for 30 years, guys. Like he said, since more than 30 years. Since the 80s and 90s, you've been dealing in notes, and so you've seen all the cycles, and you understand. And we had a great talk about that. But this is how we value loans, and this is how we look at them. Even though we might be slightly off by a few $1,000s, we're still in the same realm. And so it was a fun little exercise.
All things being equal, yes, that's right.
Yeah, all things being equal.
Yep.
So that took us to the end of the presentation part today. So we're going to start answering some questions and open up for you guys to talk. If you want, talk to Joe. Are you good and for a few more minutes, Joe?
For a few more minutes, yeah.
Okay. So I want to mention quickly that the next Note Meetup is going to be Wednesday, June 10th from 6 to 8 p.m. For those of you that would like to subscribe to our podcast, The Two Wealth Show, as we mentioned, we're going to actually interview Joe on a recording next week, which will air probably in 3 or 4 weeks later. So you'll be able to see that interview and see all the other interviews and other topics that me and Super E have. And don't forget to follow Bright Path Notes on social media, Facebook, Twitter, and Instagram. There's my email address, Justin Bogart, justin@brightpathnotes.com. And Joe, we just started a new Facebook group called Be the Bank Real Estate Note Investing.
Wow.
So this is your chance to be in a closed group that you can ask questions, and we can bring them up on the meetups. And I have some other really seasoned note investors that I invited into the group as well to help facilitate questions.
Good.
So it'd just be a great way for just some free advice or just to bounce an idea off of somebody. So I encourage you to sign up for it. Rudy, you need to get on this Facebook group too, man, because you can help answer some questions too, my friend. So I'm going to go back to the board here and start answering some of these questions.
The person you're getting the advice from is somebody that's actually doing the business, right, Justin?
Yeah. So this is the reason why I signed up for a mentorship program with Joe at Note School. And Joe actually does non-performing loans. Joe actually does partials. Joe actually does performing loans. Joe actually has a portfolio. Joe does the business, and so does Eddie, our other mentor, and so does Kevin Moore and the other trainers in the business as well. They actually do their own investing. And so I've been to many other real estate seminars before, and those people were just the face of the company. They don't actually do anything. Right. And so that's why I value so much what I've learned at Note School and being a note investor. So I'm here to share the wealth with you guys as well. This is obviously a free meetup. So I hope you guys enjoy that information. And I'm going to end the recording now, but I'm going to answer some of these questions so that we can be a little more candid. So we're going to sign off on the recording for now, but stick on and we're going to start answering some more questions right now, guys.
You guys, if you're leaving, see you now. Yep. Take care.